What's good everyone, welcome back to another video on the YouTube channel, and this video we're going to cover how to find high probability trades. So the upcoming videos will be a follow-up from my bootcamp, so if you guys have not watched that already, that's basically my free course. I go over the basics of the market and there are some advanced concepts in there. However, we're going to start building on that in my YouTube videos as we go on throughout the weeks and the months. So this video will tie into the video that I'm going to do next, and that will be about how you guys can get funded. So before we get into the video, I want to let you guys know that I will be having an interview with Funded Engineer. So this video will go out on the Sunday, the 12th of May, and my interview with Funded Engineer will be recorded on Wednesday. So I've been trading with Funded Engineer for some time now, and I do believe they are one of the best prop firms there are out there. I don't get paid to say this, however, it's just been my experience with them, hence why I'm going to do an interview on Wednesday, and I'll keep you guys posted for when the video is going to come out. However, towards the end of the video where I go over the high probability trades that I have taken, it has been on my Funded Engineer account. And if you guys want to check them out, there will be a link to their socials down below. However, let's get into the video. So finding high probability trades is not that hard. You guys need to understand liquidity. So once you understand liquidity, we will start to build on order flow. If you watched the third video of my bootcamp, that's where I went over order flow. However, we're going to go over it a bit more detail in this video. But firstly, let's talk about liquidity. So liquidity is the lifeblood of these markets. So once you understand liquidity, this is where we will pair up order flow. So when I am talking about liquidity, what do I mean? So the first form is external range liquidity. So the external range liquidity is when we have a range high and we have a range low. And you can see prices failing to trade above this high and this low. So however, if we take out one side of the market, so we go lower and take out the external low, we can look to target the external high. And this is where order flow will start coming into the picture. So you can see that we took out the external low and price started to trade higher. However, if we look at this fractal right here, where price was trading to the downside, this was all bearish order flow. So I'm going to label this in a different color. So this price movement down where we made the external low, this was all bearish order flow. So these up close candles that were made here, this was supporting price to keep trading lower. And then once price trades into the external low and we take out the sell side liquidity, what is the next area to target? That is the buy side liquidity. However, as we took out the external low and we started to trade higher, this is where we are trading against the order flow. So this is where the order flow is changing, and we can look for buying setups. So how does this form? This forms when old selling that was taking place will be used as new distribution. So this up leg right here, this is where up close candles would have formed, and this is what would have been used for price to trade into and go lower. However, that wasn't the case as we took out the sell side liquidity, which was the external low, and then we traded to the upside. So we broke bearish order flow. And you can see this was the up close candle that was made here. This supported the price move lower, and this was old accumulation. So this is what we will draw out, and this is what will support price to go higher again, and this will be bullish order flow until we reach the external high. So we look at the up close candles that supported price all the way to the sell side liquidity, and this is another way how you guys can see when price is going to reverse. This is because we've taken out the external low, price is traded higher, up close candles not supporting price to go lower again, we trade higher, close above the old accumulation area, come into it, old accumulation turns into new distribution, price trades away, and then what do we have here? This is the high probability area that you will be looking to trade. This will be the silver bullet of a market maker model, and this is the highest probability area for you to take any trade. I am going to go deeper into this topic, however this is how you guys can start framing your high probability setups and where you can be entering. So those of you that do take notes from my video, you've already noted this down. However, I'm going to go over it for the people that might have missed it. So the first step is identifying a dealing range, which was this. And you can see this is the external low and the external high. So once we have identified the dealing range, we identify the order flow. So you can see this is bearish order flow. Up close candles are supporting price to go lower. They are supporting price to go lower until we get into the external low. Once we get into the external low, we take out the sell side liquidity and price reverses. So once we take out the sell side, where are those positions offloaded? Exactly to the external high, that is the buy side liquidity. Once we see this and price reverses, you don't need to try and catch this. You don't even need to try and buy this. This is because this will be used as the confirmation for this trade idea that takes place here. Because you want high probability trades, right? And this is where they will form. If you go back to my old tweets or my old trades, this is all that I was trading. And if you go back to MMXM Trader's old trades, this is what he was taking as well. This is the silver bullet. This is the second stage of distribution in a market maker model. So as I was saying, price reverses and we break up close candles. So the order flow is shifting to bullish. And how can we confirm this? When old accumulation turns into new distribution. And if we miss this buy, that's fine because we have another high probability price leg. As you can see, we come below 50% of the dealing range. We come into here and then we trade higher. We will use the old up close candles that formed here. We will draw them out in time and we will use that to buy. And we will buy like this. Our stop loss will go below this low and we will target the buy side. So the candles that form here, they will be used as a mitigation block in the second stage of distribution in a market maker model. And this is a high probability trading entry. So if you want to take a screenshot of this, you can, as we are going to build on it more. So what I just went over there can be quite confusing, but we're going to break it down into 3 sections. So the 3 sections are external range. Once we have found the external range, we look for premium and discount inside of that range. So once we have found the external range and the premium and discount, what we do after this is we wait for one side of the range to be taken. Once we see one side of the range being taken, for example, that was the range low, so that was the external low, we look for up close candles to be disrespected if we are to turn bullish. And we look for down close candles to be disrespected if we are going to be bearish. So this is the basics to it, and we are going to build on this as we get into the video and I go over examples. However, this is how you should be thinking. So you're always looking at a range, you're looking at the premium and discount. So you obviously want to be a buyer in discount and a seller in premium. You look for one side of the range to be taken to target the other end. And then you look for up close candles to be disrespected if you're bullish and down close candles to be disrespected when you're bearish. So this step is important because we will be looking at the old accumulation that took place and we will be using it as new distribution. And the new distribution that takes place, that will be the silver bullet, and that's where your high probability entry will be, and this is where your high probability trades will be. Okay, so that was an overview of how you guys can find high probability trades, and I gave you a bonus of where you can find high probability entries. I am going to show you guys some examples. However, if you've not watched my bootcamp already, it's free on my YouTube channel. I would recommend you do so. Okay, here I have an example of Euro JPY, and this is the weekly chart. So whatever I'm explaining on the weekly chart, you can of course apply it to the lower time frames because everything is fractal in its nature. So what happens on the weekly, what happened on the 1 minute, 5 minute, 10 minute, 15 minute, whatever. So I'm showing you guys Euro JPY because, as most of you know, this is what I traded. And this is one of the reasons why I was looking to trade this. So if we look at this price leg from this low to this high and we ignore these down close candles that formed, you can see we have an external low, which is right here, and we have an external high. So price here is an extreme premium and price here is an extreme discount. So what are we looking for? We are looking for price to sweep one side of the market, which we do right here. We take out the sell side liquidity and price trades away. So on the daily chart, these up close candles that formed here, this is what supported price to continue going lower. Every time we traded into them, price traded lower. So this showed that we were trading bearish order flow as price traded lower and we took out the external low. Once we took out the external low, price reversed and we started to trade higher. So what are we looking for this market to show us is high probability? Well, first you're looking for one side of the range to be taken, which was the external low. So when price reversed and we trade above up close candles, and you can see price is starting to close above up close candles and we're disrespecting bearish PD arrays. So the up close candles are the bearish PD arrays and price is trading higher. So once we get a close right here and price starts to trade lower, this is what you don't need to trade. You just want to look at this as a confirmation, because as price traded higher and we closed above this candle, this is our mitigation block. We will draw this out in time and this will support price to go higher, which it does. Price continues higher and then we close right here. Once we close above this bearish fair value gap, this is a buying signal for us. And we can look to target the external high that's right here. So we will buy once price trades into this fair value gap, and our stop loss will be below this low, and we can target the external high, which is right here. Or if you want to target more for a 1 to 2, you can, which is right here. So you can also see this up close candle that formed right here. This is supporting price to go higher because this is our mitigation block and this is our high probability entry. You can also take this entry, however I like to enter before the external target has been taken. So this whole fractal that's shown right here, this is on the weekly chart. However, the same things apply to the lower time frames. So the most important things are we identify a range, price takes out one side of the range, and we start trading away. The up close candles that supported price, if we are bearish, we will look for them to be disrespected, which we do right here. And as they were old areas of accumulation, they will be used as new distribution in time. And we will look to trade the silver bullet or right before the external target has been taken. So you can see that this fair value gap and this mitigation block supports price to go higher. This is where we will buy and we will take profit at the external high. So let's look at this fractal on the daily chart and I will show you guys an example on the lower time frame. So if we look at the fractal on the daily chart, this is the same thing from the weekly, however on the lower time frame. And these up close candles that form here, they supported price to go lower. So you can see the wick up that was into the up close candle. They supported price to go lower. Same goes for these three. Price trades up, we trade into the up close and we trade away. So that supported price to continue going lower. Same as this mitigation block right here, supported price to go lower and we took out the sell side liquidity. So once one side of the range had been taken, we can draw out these mitigation blocks in time. Before we do that, we want to see price reverse. So we reverse, we close above these mitigation blocks now. And once price trades into the fair value gap, we are respecting bullish order flow. So the bullish order flow is these down close candles. So we are starting to respect down close candles and it's supporting price to continue going higher. We will now look at the old accumulation areas and we will utilize them for price to take out the external high. So now I've showed you guys the fractal on the daily chart from the weekly. Let's go over a lower time frame example on the 15-minute chart. Okay, here let's go over an example on Euro JPY on the 15-minute chart. So we identified the range high to the range low, which is right here. Once we have identified the range, we look at up close candles which have been supporting price. So this has been a supporting price to go lower. This candle's been supporting price to go lower. So this is all bearish order flow. We are looking for one side of the range to be taken to target the other side. So we just patiently wait. We've taken out this side of the range, which was a sell side liquidity below this low. And now all we do is we wait for up close candles to be disrespected. So we have this up close candle and this up close candle and this up close candle. So once price starts to trade above them and we close above them, this is where we can know that the order flow is reversing and we can look for buying opportunities. And then we can look for silver bullet, which forms around here. I'm going to let price action play out and we are going to wait for 8:30. 8:30 is important because if you guys watched my bootcamp, this is where I start my trading. So this is where my kill zones start for trading Forex. So if you've not already watched that video, there will be a link in the description down below. As we get into 8:30, you guys can see that the up close candles have been disrespected and price has been trading higher. Once we have traded higher, we have closed above these candles as well. However, we're waiting for 8:30 for price to trade lower and come back into a discount of this range. Because we can't buy this because price is in a premium. So you never buy above old highs or sell below old lows. So if price takes out these old lows, this is where we can look to buy and target the buy side liquidity. So at 8:30 we trade lower and we have a mitigation block right here. Once we start respecting this mitigation block and you can see how the bodies are closing above, this is where I'll buy once price trades into this down close candle. And my stop loss will go below this long-term low and I will target the buy side liquidity. And as you guys can see, price starts to trade lower. We come closer into the mitigation block. However, price still fails to close inside the mitigation block. So this is a good sign for me. This shows that price does want to continue higher. And you can see we trade into the buy side liquidity and we take out the external high. So in this video, I taught you guys high probability trades and high probability entries. And if you have watched my bootcamp, these videos are just a follow-up, giving more information, what you can add to what I've already taught to make trading even more high probability for you. And if you have any more video recommendations, leave a comment down below. And as always, thanks for watching.